Good morning and welcome to this edition of IG Live on this early part of the Tuesday morning, 21st of February. Let's take a look at the headlines as we await the start of today's European session. We got some breaking news out overnight from the Reserve Bank of Australia, where it says that inflation is far from over and the fight continues. Meanwhile, earnings out overnight from BHP, the mining giant. We've seen a drop in profit. The stock is down in the Australian markets, expect to open lower here in London. It's been counting on a Chinese recovery, and that's yet to materialise in any great shape or form. Later on today, it's the turn of US retailers. We get a snapshot of how the consumer is performing with earnings out from Walmart and Home Depot. Let's take a look at volatility, which is rising. Fourth day in a row of gains. In fact, we're up against the 50-period moving average at 2194, and we are at the top of the candle, which indicates that people are continuing to look at ways of which to reduce their risk assets. And this is seen as a drop in the markets across Europe at the start of today's trade. I want to show you this in some detail. This red dotted line is the all-time intraday record high that we've seen at 80.44. We're currently trading at 79.97. And this indicates to me that we've got, because it's below that close yesterday, we're looking for a weaker open at the start of today's trade. These 24-hour markets give us an indication as to where things are. But in the long term pattern, technically, with this gap that we've got here from the lows at 72.96 up to the highs we had on the 17th of January at 78.76. Now that is a gap which can be measured, and projecting that measure would take us up to a high technically at 84.56. But in reality, where is this going? Well, IGTV recently caught up with Justin Urquhart-Stewart, veteran investor here in the City of London, and we started by asking him about what he thought about the London markets and where things could well go for the rest of the year. This is what he had to tell us recently at IGTV.
I think the FTSE's had benefited some really good news, having been left behind, of course, by everybody else. Then you had the bad news with the tech stocks pulling some of those other markets down, and really, I suppose, you saw the FTSE playing catch up with it. But what you're going to be seeing now is, I think, more worrying about the global economy. And bear in mind, the FTSE really reflects the older-fashioned global economy. So I think we've had the best of the good news. Now, be prepared now to actually take some profits and maybe see that come back a bit, and then come back in a little bit later.
Well, let's take a look at the FTSE mid-cap 250. Now, Justin was talking there about the international exposure of the FTSE 100. The mid-cap 250 is more domestically orientated, and I think this is more about what's going on within the British economy, which isn't performing as well as some other economies around the world. Although, despite that, we've just seen some breaking news coming across the wires showing us from the ONS, the Office of National Statistics, that the surplus on the budget accounts for the public better than expected, with a surplus of $6.5 billion around about that. We've been looking for something like around about a $5 billion deficit, so that's better than expected. The mid-cap 250 index in yesterday's session was up for a second day in a row. The FTSE 100 was down yesterday, so you can see there is sometimes a divergence between the two indices. We'll open at 20,144. This is not a 24-hour market, but I just want to show you this to show you that they're well off the record highs that we had back in September 2021 at 24,290. At 20,144, the mid-cap 250 more represents, I think, really what's happening under the covers here in the British economy. Let's move on and take a look at what's happening in other markets around Europe. And like the FTSE 100, second day in a row of declines for the German DAX, 15,442. And as Justin was saying, the FTSE doing some catch up. The German DAX has been far higher than where we are at the moment, but the DAX is a more volatile index, which is why it's more appealing to us as traders for an opportunity about looking at these markets. French CAC 40, same sort of price action, second day in a row of decline, 73.15, looking for a lower start. If you're short on any of these markets, your stop would go above recent price action with a view to taking it lower today. And we've got the US markets, of course, back today, which could help give us a steer later on. Overnight in Asia is a down day for many of the markets. Nikkei 225 down just shy of 0.25%, 1.3% down for the Hang Seng. Australian ASX 200 also showing some weaknesses. We'll see in just a minute. BHP Billiton, or BHP as it's called, has been contributing to the negativity, and that could give us a little bit of a negative swing to the London markets as well at the start. Wall Street no close yesterday because of the long holiday. I just want to show you what happened on Friday, just to remind ourselves as to what went on, with gains on the Dow, but losses on the S&P 500 and the Nasdaq. But if you look at the 24-hour markets over yesterday, if you look at the chart here, you can see yesterday's candle firmly down. This was on the IG platform yesterday, trading this lower, and we've got a build-up of that on the downside at the moment for the Dow. And the declines we saw across the other markets, S&P 500 down yesterday, and in fact, if we close at these levels, it'll be the lowest close we've seen on the S&P 500 in February. This goes back to the 31st of January. These lows at 4,056. So you can see some negativity beginning to creep in again. We dropped below this rising line of support as well. And the MACD pointing lower, which to me indicates potentially there is more appetite to take this market lower. We've got a very near line of support being tested here at the moment at 12,258. 12,292 is where we are for the Nasdaq. That line was established with that high trade we had here back on the 13th of December last year. So that's why that line is drawn. So it is possibly going to be significant. We haven't seen a candle close below there since that high point that we had. And so that is a line to watch out for. If we get a candle close below there, next line of support will be the 200-day moving average, 11,893. Now, I said at the top about the Reserve Bank of Australia coming out with the minutes of its last interest rate meeting on the 7th of February, shows that it abandoned all thought of pausing its tightening policy and signaled more rate hikes would be needed in the months ahead. Now, there were only two options for the board members, a 25 basis point increase in rates or a 50 basis point, half of 1 percentage point rise. Eventually, it settled on that quarter point rise at the meeting, which brought the cash rate to a fresh decade high of 3.35%. Since last May, the RBA rates have risen by 325 basis points. Let's take a look in some more detail about what's been going on. A quote from the RBA: the recent inflation data suggested more breadth and persistence in inflation than had been expected, and that strong demand was leading to price increases in some parts of the economy. While inflation was expected to decline, the minute said there was a risk that it could persist at an uncomfortably high level, which would entail longer-term costs. The markets we're looking at here is the Australian dollar, which is down today. The Aussie is down against the US dollar at 68.77. Inflation is currently running at a 32-year high of 7.8% and is only expected to slow to the top of the RBA's target range of between 2 and 3% by mid-2025. As for the market, it expects a peak for interest rates at 4.2%, with 3.6% back in January. So you can see how there's a reason to sell the Aussie in the session in today's trade because of the stresses and strains it's likely to put on the other part of the economy as the RBA focuses itself with laser intensity on getting inflation down, which of course is really what it is all about. I want to show another chart. This is the euro dollar, which is of interest today for a couple of reasons. Let's take a look at the chart first of all to get you some depth and breadth from what's happening here. There is a knockdown lower for the euro today against the US dollar, not too far away from some of the recent lows that we've seen and not too far away from the lows we saw back on the 9th of January. The euro is trading ahead of PMI data out later on today. Flash February PMI day across Europe, UK and US, expected to show marginal improvements in economic conditions in the region. Another reason to look at this is for the 10 o'clock release this morning of the ZEW economic sentiment. It's expected to rise for a fifth straight month in Germany to 22 in February from 19.6 in January. Remember last month the index jumped by about 40 points to end a 10-month period of below flat, which means that there are more economists and analysts that are optimistic for the German economy than pessimistic. Other bit of data out a little bit later on today at 1:30 p.m. A couple of economic reports we'll be looking for in the Canadian economy. 1:30 p.m. Canada's consumer prices expected to forecast to fall to 6.1% in January year on year, continuing to cool from the beginning of the back in June last year where we saw an 8.1% print. Also at 1:30 p.m. retail sales expected to rise by 0.5% in December month on month. We'll be looking at what's happening with the Canadian dollar for that. This is the US dollar trading up at the moment against the Canadian dollar at 134.89. Is this a trading opportunity? Well, possibly. It depends on the direction of travel. If we get some strong numbers, could we get some money going to the Canadian dollar? It's entirely possible, in which case you go short on this chart with a stop above the highs that we saw just a few days ago, around about the 135.60 level. 134.90 is where we are at the moment. There is a little bit of money going to the US dollar at the expense of the Canadian. But if we do see strong data coming through, this chart would then go lower, your lower US dollar against the Canadian. If it travels in the opposite direction, if there's a reason to sell the US dollar against the stronger Canadian, you'd be long on this chart. That would only be the case if we saw some weak data coming through in Canada. Meanwhile, on the other side of this trade, in the US at 3 o'clock this afternoon, existing home sales expected to rise by 2% in January year on year, ending 11 months of declines. So that's a wrap of some of the data we are expecting today. Let's take a look now at some of the corporate news headlines we're looking for and some of the changes we could well see in the London markets because of what's been happening. BHP Group posting earnings earlier today, whilst the Australian markets were open, a larger than expected fall in first half profit. Let's take a look at the figures there. Underlying profit from continuing operations falling 32% to $6.6 billion, missing estimates of $6.8 billion. Group proposes an interim dividend of 90 cents a share. Now that's down 40% since this time last year. BHP said it logged a $1 billion inflation hit primarily from diesel costs for the half and added that the lag effect of inflation and continued labour market tightness will impact on costs into the 2024 financial year. One of the bright spots, though, was China, despite the fact it hasn't really moved up in terms of demand as many have been expecting. It seems to be what the company says a source of stability for commodity demand. According to BHP CEO Mike Henry, there's a lot of us out there that's giving us confidence, and we will see an acceleration of the Chinese domestic economy at some point in the not too distant future. Now, let's take a look at what's been happening. This is BHP in the London markets. Big gains yesterday at 28.53. Let me tell you, it was down 0.4% at the close of the Australian markets today. So potentially we could well see somewhat of an unwinding of yesterday's move up in that number. I want to stay on the chart because I wanted to stay within the mining sector and just bring up a chart of Antofagasta. Now, this is the world's largest listed copper producer, and you can see recently that we've lifted above some of the price action that we've seen back in 2022 to take us in the last few weeks to levels not seen since May 2021. Now, we're opening at 1761 this morning. It's reported a 39% fall in full year profit, as well as BHP seeing some weakness. High input costs and a drought in Chile has hit its copper production. EBITDA was $2.9 billion compared with $4.8 billion in the previous year. Could we see some declines at Antofagasta at the start? I suspect it could well be possibly likely, in which case you put your stop above the 1800 level with a view to taking this lower from 1761, which is where that is due to open this morning. Let's shift out of miners into banks. And earlier this morning, we had a chance to see a reaction in the Hong Kong markets to earnings out from HSBC. And it looks like that could well be on the move this morning in the London markets. Let's take a look, first of all, at the figures. Posting a 92% increase in quarterly profit, beating estimates. Pre-tax earnings rising $5.2 billion for the fourth quarter, up from $2.7 billion this time last year, and ahead of the $4.96 billion average estimate of analysts compiled by the bank. Despite the fourth quarter increase, annual profits fell to $17.5 billion from $18.9 billion this time last year due to an impairment of $2.4 billion related to the sale of its retail banking operations in France. Annual credit losses rising $3.6 billion. More than the $3.2 billion expected. Now, this is, like a lot of these banks, a warning shot across the bows because of concerns about the long-term impact of the failure of people potentially to pay down debt. Rather, they will otherwise go into some sort of bankruptcy, which means banks do have to put aside more provisions for potential bad loans. Now, this rise that we see in HSBC, taking us in the London markets up to 620 pence. Yesterday, in fact, we saw the highest print in shares we've not seen since the 2nd of October 2021. Now, the thing about HSBC, if I bring up what's been happening in Hong Kong, you will see in the session there that we got a drop back in shares. We were down 2.47%, quite a marked decrease as well. So potentially we could well see a drop in the London markets for HSBC at the start of today's trade. So you've got to think about that as an opportunity potentially as a company worth looking at, potentially on the way down in the London markets. And that would take us down below this 620 level, which is where the stock is likely to, well, will open this morning at the beginning of today's trade, down 1.3% in Hong Kong. Staying on the charts, just wanted to go back and take a look at one other area of the market which has been doing so well recently, and that is Intercontinental Hotels Group. And in fact, if you bring this chart up, in the last couple of weeks, we've seen a new all-time record high at 57.96. This is the company that owns Holiday Inn, amongst other really big, well-known brands. And you can see this move up that we've seen since the company came to the market as Intercontinental Hotels Group back in 2003. It's posted higher than expected full-year profit, helped by strong occupancy demand during the holidays and higher room prices. Operating profit up a whacking 55% to $828 million. The group plans to buy back shares to return an additional $750 million to shareholders in 2023. It opens at 56.07. Could this be a gainer at the start today? If it is, stock goes down here underneath the big red candle we saw just a couple of weeks ago. You'll stop at about 54.20. 56.07 is where we open. Could we see a new print above 57.96? Well, it depends on how the markets interpret the results. But if you're long on that, that's where your stop goes down there. If you think there's enough negativity, or rather there's sufficient amount of investment already made in the stock, and you think people might sell on this news, then your stop goes above this area up here at around about the 58.20 level. Now, let's take a look at another area of the market worth looking at, and this is what's happening before the bell in the United States today. We've got Alibaba out with earnings. This is a company that trades in the US markets as an all-session stock, and it trades under the ticker symbol BABA. Let me just bring that up for you so you can take a look at what's been happening with Alibaba. Well off the highs that we had, the record highs we had in Alibaba when Jack Ma was still around, up at $319.27. It will open at 9 o'clock this morning, all sessions on the IG platform. No trade yesterday because of the holiday in the States. It'll open at 99.97. It's expected to report pre-market this morning. The Chinese e-commerce legacy business facing real challenges to revive its growth despite China's reopening and the abating of some of the regulatory fears that have been building up in the Chinese amongst the Chinese authorities. Consensus earnings per share forecast for the quarter $1.89, higher than the $1.50 reported in the previous quarter, but remains 14% lower than the same quarter this time last year. Group's revenue anticipated to have shrunk some 6% year over year to 35.85 billion. Many people shaking their heads in disbelief as to what the Chinese authorities are doing to these big tech companies that could have been doing so well. And we've just been hearing recently one of the boutique banks has lost its chief executive in another one of these disappearing acts that these Chinese billionaires have been fearing and worrying about, and indeed having to endure. Alibaba used to impress its shareholders with a convincing track record of growth. Its 5-year annualized returns growth rate is up to 15%. However, since early 2022, which is this area here on the chart, the Chinese tech giant's earnings have been declining for 3 straight quarters due to subdued revenue growth, which has been driven by the will of the Chinese authorities. Walmart scheduled to report its fourth quarter earnings before the market opens as well. Another all-session stock. Let's take a look at those figures. We're expecting earnings per share of $1.52 on revenues close to 160 billion. The last 12 months, Walmart's seen its share price increase by just over 8%. But the period has been quite a ride for the retailers. You can see this really sort of jagged, tradable movements that we've seen here. But you get caught the wrong side of that, and you can really easily get stopped out because of these violent moves. Look at that green candle we saw there on the 15th of November. It's a really rocky ride and some really interesting moves. We'll see this stock open this morning at 9 o'clock on the IG platform at 146.78. You can trade this when it comes through with numbers. Another all-session stock is Home Depot. That group's expected to post earnings of $3.28 per share on revenues close to 36 billion. Now that's down some 7% year on year. So Home Depot is another one to watch out before the bell today in the States. Just looking at what's happening with Home Depot shares on the chart, away from the recent highs at $341.40. The stock will open at $317.30 at 9 o'clock this morning. And another all-session stock is Coinbase. Coinbase Global, fourth quarter expectations before the bell today, loss per share of $2.51 on revenues of 588 million. Coinbase is a digital cryptocurrency exchange. Look at the moves that we've seen. Well, in fact, away from the record highs we saw back at $370. The stock will open at 9 o'clock this morning at 64.94. Look at the move that we've seen recently, a drop of 38% from the highs back on the 3rd of February. And of course, this to some degree is a proxy for the trading of Bitcoin. Bitcoin is not possible for a lot of traders trade because they're not premium clients. But if you are a premium client, you'll have seen Bitcoin recently rise to levels or up to the point we saw back on the 15th of August last year, looking like it could well want to break higher to levels not seen since June 2022, if it does go much higher from where we are at the moment. But money going back into Bitcoin, and this is only going to be positive, I think, for Coinbase in the longer term. But watching out for those earnings this morning, looking for a loss per share of $2.51. Well, to stay on the charts, just wanted to update you on a couple of other areas of the market, just to show you for the sake of pointing out what's happening. A little bit of mixed trading the last few days for oil. It's down on the session today. MACD pointing lower, potentially could well see some further pressure building. You've got support kicking in. We're currently trading at 83.14, support at 80.30. This is for Brent. And just to wrap it up with what's going on with spot gold, similarly, we got declines there being held up by this line of support, which was established by the high print we had back on the 27th of December at 18.33. That's it from me. Back at 10:30 with Chart in the Markets. Do watch out for Intercontinental Hotels at the start today, looking potentially for losses as well for HSBC and BHP, after both having declined in Hong Kong and Australia respectively early this morning because of earnings. But IHG, one of the big numbers out, I think, potentially this morning, possibly on the upside after those earnings impressing investors.